How much more pain generally do you see for the emerging world right now?
Well, I think like the big call now is to do with China, because I think that as far as the economies today which you look that are vulnerable, their size is really very small for the global economy, like Argentina, Turkey, even South Africa. You take them all together, their size in the global economy is about 2%. But here's this problem currently, which is that China also has some vulnerabilities. The main vulnerability being that if you look at the last decade, more than half of the increase in global debt has taken place in just one country, and that's China. And if something happens in China, that has major implications because China, as we know, accounts for 16% of the global economy.
I mean, clearly the countries that have been in the eye of the storm during the summer and in August particularly, the likes of Argentina and Turkey, people always point to the fact that they have these twin deficits, fiscal deficit and a current account deficit, and that's partly why their currency has been tanking so much. They've got to honor their debts and they've borrowed in foreign currency. That doesn't really apply to China in the same way, does it?
Exactly. So therefore, my base case is not that something really bad happens in China, but China does have a problem. Is something we have to recognize, that for this emerging market contagion to really take the next leg down, something has to happen in China is my point. Otherwise, I think that with the dollar stabilizing, we can come out of the woods, and this may, in fact, represent a great buying opportunity in some of these markets, because some of these markets are really beaten down. Like the earlier segment was showing what the divergence between the US and the other emerging markets and the global markets has been this year. But remember that divergence also means opportunity, because the last time you had such a massive divergence and the US markets so dominated the global financial landscape was in the late 1990s, which set up then the great decade for emerging markets subsequently. So I do think that we're coming pretty close to a point where this is going to turn out to be a once-in-a-lifetime buying opportunity for some of these emerging markets, rather than the despair we have today. The issue is that do we have one final leg down? And that for me is going to really depend on the fact that does China get caught up in what's going on out here? Because as you're right, they don't have the classical problems of a large current account deficit or a fiscal deficit, but they do have a very large increase in debt. Their currency has been sort of pegged to the US dollar. And this is a really important point. For the first time, at least in my memory, US and Chinese interest rates have converged, particularly like 2-year interest rates. And that means that the incentive for the average Chinese to take their money out of the country is pretty high when you ask the question as to what sort of paper do they want to hold.
I mean, the Chinese currency, though, has stabilized recently. So what would lead you to this biggest opportunity of a lifetime to buy into emerging markets? Because a lot of these markets are still bleeding.
Yeah, I mean, as I said, that I think that if China stabilizes out here and the dollar stabilizes, that really ends up being a big opportunity. We were just speaking about it here, that at some point in time, these valuations need to matter, especially on the currency front. The Mexican currency, the South African currency, these currencies, even the Turkish currency, are not getting to extremely cheap levels. In general, the dollar is very expensive. And so if I have to look out to the next 3 to 5 years, I think the dollar will be weaker, not stronger, in the next 3 to 5 years.
In terms of your scary scenario, we were just looking at the Chinese yuan. It's at 6.8 or so against the dollar. What level would start to make you worried that China could be drawn into this sort of emerging market capitulation?
Well, in the very near term, I think that they've really put the line in the sand around 7. So, like 7 is where the level, at least if 7 were to give away psychologically, that would be a problem. The other thing worth monitoring are China's foreign exchange reserves. That do we begin to see a decline of those foreign exchange reserves? Because that's what, remember, happened in late 2015, early 2016, which then came back to have a blowback impact on the US as well. So the US markets have been pretty Teflon-like, ignoring this entire emerging market crisis. In a way they did in 2013 and 2015 as well, until it really began to impact China. So I think that even for the US markets, watching China is really important. Turkey, Argentina, no, I don't think that's big.
And if we see a drawdown in those reserves, it means it's getting too expensive to defend that currency, and then you could see weakness spill over here.
Yeah, but that means that the capital outflows have begun again in earnest, because the big difference now is that China no longer has a current account surplus. That's disappeared in China now. So if you begin to see foreign exchange reserves begin to decline, and you have the first data point on that, I think, on Friday, when we begin to see what happened to their FX reserves. Now, of course, There are many ways they can conceal some of that, but that trend will be visible in the next few months.
And very quickly, in the positive case scenario, if you had to pick one EM country that has been hit too hard for what it deserves and you'd be telling people to buy, which country?
Eastern Europe, Poland in particular. Because I think that some of these Eastern European countries are booming, they're growing very rapidly, but they've been caught up in the whole negative sentiment towards Europe. So Poland would be my one country which is trading today at a multi-decade low in relative terms compared to emerging markets and the US. I would say that that's the place you buy.